Hey everyone, welcome back to another dividend investing video. A Dividend Aristocrat is an S&P 500 company that has increased its annual dividend payment every year for the last 25 years or more. But even more impressive is a Dividend King. This is a company that has been raising their dividend for 50 or more years. With stocks rallying, finding value is becoming harder. Most of our favorite stocks are up over the last few months. Times like these, I like to look for quality, dependability, reliability, and these Dividend Kings are an excellent place to do some research. So I did a screen on the Dividend Kings list and have found the top 5 Dividend Kings ranked by their 5-year dividend growth rate. These are all companies that have raised their dividends for 50 years or more, and their 5-year average annual dividend growth rates are all in the double digits. So these are some fantastic companies. I'm excited to share these with you, so let's just get right into it. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. So I've ranked these stocks by their 5-year average annual dividend growth rate. This basically means if you look at the last 5 years, how much has this dividend increased on average year over year in that time frame. So I'm not going to go too deep into any of these. I just want to give you some basics about the companies and where the company is right now. As always, this is meant to spur further research into these companies. And please stick around until the end. I do have an important update about another Dividend King, Johnson & Johnson, to follow up on from our last video on that Kenvue stock split, or exchange offering to be more accurate. The Dividend King, growing its dividend the 5th fastest in the last 5 years, has been Illinois Toolworks, ticker ITW. Illinois Toolworks is a Dividend King with 51 years of consecutive dividend raises, and its 5-year average annual dividend growth rate is 12%. Illinois Toolworks is in the industrial sector. They manufacture and sell industrial products and equipment worldwide. They've been in business since 1912 and are based in Glenview, Illinois. Year-to-date, shares of Illinois Toolworks are up 16.90%. Share price is hovering around its 52-week high. But how has it been doing on a longer-term basis? ITW has a total return of 348% over the last 10 years, a substantial improvement over the S&P 500's 226% in that time frame. That total return includes price appreciation and dividends. ITW is trading at a PE of 26.3. This is 12% above its 5-year average, so the stock is looking overvalued from this point of view. Shares are yielding 2.05%, and that is 13% lower than the Illinois Toolworks 5-year average yield of 2.36%, so also overvalued by dividend yield theory. This dividend is paid out quarterly in the amount of $1.31 in the months of January, April, July, and October, for a total annual payout of $5.24. Their dividend payout in October is expected to be its 52nd annual increase. We'll learn more about how much that will be in the next coming weeks. The Illinois Toolworks dividend is considered safe. Simply Safe Dividends provides a safety score of 81. The dividend takes up 54% of forward earnings and 51% of forward free cash flow. The average analyst price target for Illinois Toolworks right now is $241.45, actually representing 5% downside from where shares are today. So this is one for the watch list. Long-term, high-quality company. You're not likely going to find it cheap. That's Illinois Toolworks, the Dividend King with the 5th fastest growing dividend. The Dividend King growing its dividend the 4th fastest in the last 5 years has been Nordson Corporation, ticker NDSN. Nordson Corporation is a Dividend King with over 60 years of dividend raises. Its 5-year average annual dividend growth rate is 14%. Nordson is another company in the industrial sector. This Ohio-based firm designs and manufactures dispensing equipment for consumer and industrial adhesives, sealants, and coatings. They've been in business since 1954. Year-to-date, shares of Nordson are up 2.9%, so underperforming for the year 2023. On a 10-year basis, Nordson has outperformed the broader market with a total return of nearly 274% over the last decade. Nordson is trading at a forward PE of 26.2, just a smidge above its 5-year average of 24.8. But shares of Nordson are yielding 1.06%. This is 11% above its 5-year average, so a little undervalued by dividend yield theory. It's mind-blowing that a stock could be growing their dividend for over 50 years and have that kind of yield. So that's also a sign that it's been appreciating in share price. So this could be a nice compounder. The dividend is paid out quarterly in the amount of 65 cents per share in the months of January, March, June, and September. That's a strange payout schedule. Their total annual payout is $2.60 per share. SimplySafeDividends.com gives it a very safe dividend score of 94, and their dividend has plenty of room to continue their excellent growth track record at 28% of forward earnings and taking up 27% of forward free cash flow. Nordson has an average analyst price target of $256.14, representing about 4.5% upside from where shares trade today. So that's Nordson Corporation. You don't hear much about this one, but they are a dividend king, and they are growing their dividend at the fourth fastest rate. Their latest raise was an impressive 27% back in last August, so next month we'll be looking out for that next dividend raise from Nordson Corporation. The dividend king growing its dividend the third fastest in the last 5 years has been S&P Global Inc., ticker SPGI. S&P Global is a new dividend king, just now hitting their dividend king status. And its 5-year average annual dividend growth rate is 15%. S&P Global, part of the financial sector, they provide credit ratings, benchmarks, analytics, and workflow solutions in the global capital, commodity, and automotive markets. They're also a majority owner of the S&P Dow Jones Indices, a massive, massive player in our stock market. Year to date, shares are up over 27% for S&P Global, trading right up near that 52-week high. SPGI has brought in a huge total return over the last 10 years, returning 692% in total return, which completely trounces the broader market. This one has just been buy, hold, and let it ride. But that quality comes at a steep price indeed, with a forward PE ratio of 33.1%. So not only is it pricey, but it's 17% above its 5-year average PE. And from a dividend yield perspective, it's another lower yielder. Shares are at 0.84% yield. But this is 6% below the 5-year average of 0.91%, so it's pretty close to being in line for dividend yield theory on a fair value. The dividends paid out in the months of March, June, September, and December at 90 cents per share for a total annual payout of $3.60. And the next ex-dividend date is August 25th. Plenty of time to get that September 12th dividend. Simply Safe Dividends gives S&P Global their highest safety score possible at 99. Very safe. S&P Global have perfectly low payout ratios, 29% on forward earnings, and 22% on forward free cash flow. And Wall Street analysts give SPGI a price target of $440 per share, representing about 3% upside from where shares are today. Like many stocks, this one is up, so be careful, but maybe add to your watch list because SPGI is the dividend king with the third most impressive dividend growth. The dividend king with the second fastest dividend growth in the last 5 years has been ABBV, ticker ABBV. ABBV is the dividend king with 51 years of consecutive dividend raises. Its 5-year average dividend growth rate is 17%. Not just that, ABBV is a spinoff of Abbott Labs, and the S&P 500 Dividend Aristocrats Index give ABBV credit for Abbott's long dividend growth history, so we're going to count that here too. ABBV is biotechnology in the healthcare sector, probably best known for their autoimmune drug Humira. The year-to-date, shares of ABBV have dropped nearly 13%, and shares are closer to the 52-week low than the 52-week high today. ABBV has been an excellent investment over the last decade. Shares have a total return of 381%, vastly outperforming the broader market. That's been a trend for all of these high dividend growth dividend kings. While shares have been down lately, the valuation for ABBV has climbed over the last couple years, putting the PE 40% above its 5-year historical average of 9.3. Shares of ABBV are yielding 4.18%. This is 12% below the 5-year average yield of 4.77%, so we're also overvalued per dividend yield theory. Now this one is paid out quarterly in the amount of $1.46 per share in the months of February, May, August, and November for a total annual payout of $5.92 per share. Simply Safe Dividends rates ABBV with a dividend safety score of 70, safe. The dividend takes up 54% of forward earnings and 55% of forward free cash flow. These payout ratios are slightly elevated from where we'd like them to be, but this looks like an outlier compared to their history. Now here's one with some potential upside. Average analyst's price target is at $164.02, representing a 16% appreciation from where shares sit today. So while overvalued by a few metrics, the stock is down like most healthcare stocks have been in 2023. I think you could do a lot worse than ABBV, the dividend king with the second most impressive dividend growth. All right, drum roll please. The dividend king growing its dividend the fastest over the last 5 years is Lowe's Companies, ticker LOW. Lowe's is a dividend king with 62 years of dividend growth. Its 5-year average annual dividend growth rate is 20%. You know Lowe's, they're a home improvement retailer, part of the consumer discretionary sector. They have 2,181 home improvement stores in North America and are the second largest hardware chain on the planet, practically a duopoly. Lowe's has had a strong year, up 17.5% so far, year to date, pushing that 52-week high higher. Lowe's, on a 10-year total return basis, destroys the broad market, more than double at 531% total return over the last decade. Lowe's is at a PE ratio of 17.3, just a hair below its 5-year average of 17.8. Looking reasonably valued compared to itself, not nearly the deal it was in the last half of 2022 when I thought it was a pretty clear buy. Shares of Lowe's are now trading at a 1.88% yield, right in line with the 5-year average, so fair value in terms of dividend yield theory. Lowe's is on the February, May, August, November payout schedule, paying out $1.10 per share for a total annual payout of $4.40. Simply Safe Dividends gives Lowe's a safety score of 93, very safe. The Lowe's dividend makes up 33% of forward earnings, 28% of forward free cash flow. Now, the average analyst price target is $233.55, pretty much right where shares are today. So those were the 5 top-ranked dividend kings ranked by their 5-year average annual dividend growth rate. What do you think? Do you own any of these companies? Let me know down in the comments, please. I personally own ABBV and Lowe's for full disclosure, but these are the kind of companies I plan to rely on to help fund my life after I can escape the 9 to 5. Now this video does well enough, maybe the next one in the series could be the top 5 dividend kings ranked by their latest dividend payment, because some of these latest dividend payments have not been that impressive. As for Johnson & Johnson, if you happen to watch our last video, I talked about the Kenvue split, that investors are going to have a choice to make. No sooner than 3 hours after that video goes up, J&J announced some more details, so I need to share this now with you in regards to that exchange offer for separation from Kenvue. On July 28th, J&J announced its intent to split off at least 80.1% of its shares of Kenvue via an exchange offer. So this offer is going to permit J&J shareholders to exchange some or all or none of their shares of J&J for shares of Kenvue at a 7% discount, subject to an upper limit of 8.0549 shares of Kenvue common stock per share. Now, shareholders are expected to receive $107.53 of Kenvue for every $100 of J&J stock tendered. So if this exchange does not unload the amount of shares to divest as the percentage is needed, then they'll make a tax-free distribution to its shareholders in shares of Kenvue. Now, if you'd like to learn more about J&J, you can see where my buy price for J&J sits by clicking into this next video. Thank you so much for sticking around, and until next time, keep investing.